Hello and welcome to Acting on Finance. I'm your host David, a man with a voice you wish you could strangle and eyebrows you wish would shut up. This is Finance in 5, providing you the biggest news from the finance world this week in 5 minutes without providing you with that mind-numbing pain at the back of your eyes you get whenever you hear the ABC News theme tune, or Baby Shark. It has been another stellar week of watching our financial system behave like a feral possum trapped in a laundry, unpredictable, aggressive and operating on pure panic. The Australian share market staged a massive 1.98% rally on Friday, closing at a majestic 8,804 points. Now, if you don't follow finance, you might think, wow, Australian workers must be crushing it. No, it had nothing to do with us. The stock market doesn't track current productivity. It tracks vibes and future expectations. Our market went gangbusters on Friday entirely because Donald Trump tweeted out a vague, unverified memo hinting at a peace deal. Instantly, global oil prices plunged on the belief that the Strait of Hormuz would be open faster than a new Guzman y Gomez location. Because cheap oil means future transport and import costs for giants like Woolworths and BHP will theoretically go down, expanding their profit margins and making the companies more profitable. So the market is assuming that future expectation today. With those complex and intricate mechanics in mind, look out for Monday, when the markets will be down 8.5% because Trump tweeted the words whale-killing windmills, Iran, and the word kafefe with a question mark. Moving on to daily survival, the cost of living crisis shows no signs of letting up. The Reserve Bank meets next Tuesday to decide the official cash rate, which is currently stuck at a painful 4.35%. Fresh data dropped this week shows the Australian economy grew by a microscopic, sluggish 0.3% last quarter. In the economy's defence, that is still larger than the box office returns for Grogu and the Mandalorian. Think of the RBA as the economy's doctor, and our economy needs some delicate care to get back on its feet. The only medicine they have is a giant sledgehammer. When inflation is high, they hike rates to intentionally force anyone with a mortgage to give most of their hard-earned cash back to the banks. If you have no cash, you stop buying clothes or going to cafes or being happy. Less money circulates, demand drops, and prices cool. Basically, they work on the exact same principle as that diet you started after New Year's. The moment you start to see real progress, it's time for a cheat meal. Except in our case, the Reserve Bank had us all on a strict diet for the last few years, then suddenly said, let's have a cheat meal before turning around and scolding us for being fat. And now we're back on the diet that absolutely no one wanted. It's the world's most depressing economic yo-yo. Because our economic growth has practically flatlined, Australia's big four banks have completely lost their minds trying to predict what the RBA will do next. Economists split into two camps here. Dovish, meaning they want gentle lower rates, and hawkish, meaning they want aggressive higher rates. Think of it like Canadians versus Americans. Right now, CBA, ANZ and NAB are being the doves, the Canadians. They looked at the terrible economic growth data, apologised for it, sorry, and declared the rate hiking cycle dead. But Westpac broke ranks on Friday to issue a fiercely hawkish warning, predicting 2 more interest rate hikes this spring because the government gave everyday workers a slight award wage increase. This teaches us 3 things. 1, the doves are looking backward at past GDP data, showing the economy is already hurting. The hawks are looking forward, terrified that if you can afford a block of cheese, it will trigger a wave of cost-push inflation. And 3, that paying people millions of dollars a year to run a billion-dollar bank doesn't mean they know what they're actually talking about. Now let's check in on our national religion, the property market. Fresh data from CBA and AMP Capital confirmed the housing market is rapidly losing momentum. Following the May budget, the Australian property market experienced a significant downturn as national auction clearance rates dropped to 55%, with Sydney and Melbourne dwelling values falling 0.8% in a single month. AMP Capital and the CBA suggest a further 5% national price decline is forecasted due to weakened investor sentiment and regulatory uncertainty surrounding the new tax policy. Coupled with the previously mentioned interest rates being the highest they've been in years, this creates the perfect storm for a property downturn. In fact, top economists are warning this isn't just a temporary dip, but a prolonged multi-year stagnation that could signal the official end of Australia's historic 30-year property supercycle. Or, as property gurus will tell you online, leverage your equity in these secret boom suburbs. This will be the best year yet for property. Turning to future overlord news, the stock market was completely upended on Friday when Elon Musk's SpaceX officially completed the largest record-breaking initial public offering, or IPO, in world history. It raised an astronomical $75 billion, surged 19% in its first day of trading, and officially crowned Musk as the world's first multi-trillionaire and leader of the human race. For the uninitiated, an IPO is simply the very first time a private company opens its doors to sell its shares to the general public on the open market. And that's it for another week of finance. I've been your host and a man who makes you ask the question, is there such a thing as someone having too much diction? So, like, subscribe and tune in next week for another financial roundup, and Check out my other videos on finance and influencer BS.